Okay, that's the recording and the transcription started. As ever, I will upload these to YouTube because I know that you just can't get enough of listening to me. Okay, so what we want to do today is move on to risk. Now, I want to be really clear before I start doing this. Risk is a huge subject. There is absolutely no way that in a short course like this I can cover every type of risk, every way of identifying it, every way of managing it. It's just simply impossible. So what I'm covering today, and I will mention it later on in the slides as well, but just I want to make it clear up front. What I'm covering is an approach. It's not the approach, because depending on which sector you work in, depending on which issues you have, you may want to take other approaches. So the things that I'm talking about are reasonable, and they're reasonable, I think, for all organizations, but it's not the be all and end all. I don't want you thinking after we've done this, oh yes, I know all about risk. No, you don't. And in fact, one of the key things about risk is that it's about understanding your organization and identifying the issues within your specific organization. Yes, some of them are cross-industry. Privacy issues, GDPR issues. There's not an industry that doesn't touch. But different organizations will have different things. Someone's saying that there's distortion. Is that just one person or is everyone else okay? Yeah, Margaret's okay. Might just be you. Is that okay? Yeah, I'm getting thumbs up from other people. Have a wee check. Just make sure all your cables are plugged in and everything. So with that caveat, let's talk about risk management. And it's not something we can ignore, because everyone and everything takes risks. Of course we do. Crossing the road's a risk. These days, opening your gas bill's a risk of heart attack, if nothing else. If we all take risks, so then do organizations. It's not that we take risks. The idea is to minimize the uncertainty. If we never took risks, we wouldn't have walked on the moon. But on the other hand, we didn't just light up a Roman candle and stick a couple of people on top and see what happened. We tried to work out what was going on. We tried to think about areas of uncertainty, and we tried to address and minimize those so that we had the best opportunity for a proper completion of the project. And in fact, that's what this thing here says. Some of you may have come across ISO 31000. That's the international standard for risk. And the international standard doesn't say, oh, you must get rid of all risks. Oh, risk should be removed from the equation altogether. Oh, risks are not allowed. It says minimize the effect of uncertainty. So what we're trying to do is understand the problems that we have or may have and try and understand what we could do about those. And sometimes those are out of your hands. For any of you with a mortgage, there is huge uncertainty about how much you'll be paying shortly. What can you do about it right at the moment? Absolutely nothing whatsoever. So It's right to recognise it as a risk, and it should be on your personal risk register. But for the column that says how to minimise it, there's nothing other than ensure that you have enough money to pay it. So then the knock-on comes elsewhere. You might want to spend less on holidays or less on a car, whatever. The bottom line is we need to identify what the risks are, and we need to manage them to the best of our ability. And we do that everywhere, all the time, every day. And I know that we do that because here's a stat for you. It's 6 years out of date, but 6 years ago, there were over 180,000 road traffic accidents in the UK. So 6 years is plenty of time to get rid of all the cars, dug up all the roads, stopped people driving. Well, no, we've not done any of those things, even though there were nearly 1,800 fatalities in that year. The question is, what do we do about it? Because no one is seriously suggesting that we don't have roads anymore. No one is seriously suggesting that we don't travel anymore. So we've identified the risk. How do we manage it? And there's different ways that we can approach risks. So we can approach road accidents by avoiding them. Sadly, this audience is a wee bit old. For an audience of teenage undergraduates, I always make the joke about staying in bed is something that they've chosen to do for 4 years. But for most of us, it's not really practical. So we think about what else we might do, and our management is to educate people. Some of us are old enough to remember the Tufty Club. I still have my badge somewhere. Some of you will remember the Green Cross Code Man. There have been all sorts of education campaigns to try and get people to be safer on the streets.
Hi there. Uh-oh, this looks dangerous. Will they see that car? Think I better have a word with those two. That wasn't very clever, was it? If you'd been looking and listening all the way across, that wouldn't have happened. That's better. Remember, always use the Green Cross code, because I won't be there when you cross the road.
So there's a whole series of these things to try and educate children on how not to have a road traffic accident.
If you're between 40 and 65 years old and still don't have life insurance, well, this...
And I think that wee guy's mum had the same knitting patterns that mine did. I'm almost certain I had his jumper. So there's been lots of these things over the years, ways to approach this. And we have chosen education as the one to do it. We haven't chosen to remove the risk. We haven't chosen to avoid it. We've accepted the risk and said, okay, we are going to continue on. So let's think about some of the options that we have once we identify a risk. In other words, how do we manage risks once we understand what they are? And this is one of the things I was talking about at the start. I'm going to cover 5 approaches: accept, avoid, transfer, mitigate, and exploit. They're entirely reasonable, and it's a reasonable cross-section, but there are other ways of doing it. So don't ignore the other ways when you're doing your researches, because it might be more appropriate for your specific risk. So this is a reasonable set. So that's how we look at them, starting on accepting. And that's what we've just said about road traffic accidents. We accept that there will be road traffic accidents as a function of having roads and having cars and having people on them. So we accept the risk, but we try to educate people about it. And it's weird because normally when you accept a risk, you think of it in terms of small risks. Now, the chance of somebody being killed on a road clearly isn't a small risk. So why is it small in this context? Well, it's small in that there were 1,800 people killed out of over 60 million in the UK. So in percentage terms, that's tiny. So for each of the people involved, it's huge. So there's a difference in magnitude depending on your point of view, which end of the telescope here. For most of accepting risk, it's about small risks, things that you're willing to accept. Now, small clearly is a subjective term, and you have to decide what terms you're using when you define small. Is it, I am willing to accept the chance of my washing machine breaking. I will not take out a service policy on my washing machine because it costs £250 to buy a washing machine and a service policy costs £20 a month. So basically I could have paid for a new washing machine after a year. So you self-insure. You say, okay, I'm going to take that risk that the washing machine might break, but if it does, I'm better just fixing it myself rather than having something in place to mitigate it. It's also about time. How much time would it be if something went wrong? And I think I've used the example before about your computer system. If my home computer system goes down, I will live without watching YouTube for a week. If my work computer system goes down, then I have a big problem because I've got lots of employees and I have got lots of customers all sitting around doing nothing for as long as it takes for that computer system to get fixed. So I might want to say, right, I want to minimize the time. But here's where we have competing issues. If you want to minimize the time that your computer system goes down, it's going to cost you more money because you might keep a backup machine sitting there and that's going to cost you money. Or you might have one of these policies in place where people come out and fix it, but that's going to cost you money. So it's about balancing all these things as well. Right at the other end of the scale, there's things that might happen that you ignore. Depending where you are, you might think, well, the chances of me getting hit by a meteor, who cares? But if you work in the International Space Station, it's not just a risk. It's mapped out in terms of how much risk it would be depending on where it hits. If it hits a solar panel, annoying, we'll have less power, but we can easily fix it. Hits face on to the habitat, oh dear, all the air goes out of the space station and we die. If you're a Labrador, you might not need a helmet for meteor impact strikes. So it depends on who you are, where you are, and what the chances are. So we're back to risk being about your organisation, and each organisation is different. It's different in the types of risks that it faces, and it's different in the approaches it would take to them. And I apologise, I mean, no doubt I am mispronouncing this. Huzaifa? Huzaifa? You've got your hand up? Huzaifa, you have your hand up? You have a question? You're on mute.
Sorry.
Did you have a question?
No, sorry.
Oh, okay. Okay, so that's our first approach. We can just accept it and just say, okay, it's something that's going to happen. It either won't affect us that much or there's nothing we can do about it. So we just accept it and move on with our lives. Our next approach is to avoid it. If we identify a risk, is there a way that we can avoid it? If we are crossing a road and there is a bridge over the road, maybe we could take the bridge rather than going on the carriageway. Maybe if we are crossing a road and there is a pedestrian crossing, maybe we could go to that, press the button and wait rather than just jinking across. The example up there is a common one for organisations who have end of year accounts, quite often at the end of March. The financial year is often April through to March. You don't want to take the risk that you won't be able to close off your accounts. So maybe don't allow your accounting staff to go on holiday in March. That's avoiding the risk. If I put in for a holiday for next Thursday, the risk, of course, is that there's nobody here to cover this class. So my organisation will avoid it by saying, no, you can't do that. So avoidance can be helpful where you can. Of course, you can't always avoid risk. I've already said that risk is a core part of being alive. So maybe we can transfer the risk to other people. And you all know about transferring risk. If you have a house, you probably have house insurance in case your house goes on fire. If you have a car, it's mandated by law that you have insurance. Not just because your car might go on fire, but because you might set fire to someone else at the same time. So transferring is a good strategy, but only in certain circumstances. And the circumstances are that you have to be very clear on what the risk is. I am insuring a 5-year-old Ford Galaxy. A 5-year-old Ford Galaxy will sell in the shops for £20,000. Therefore, if you cannot use your Ford Galaxy anymore, I will give you £20,000. And then you do the calculation. How many Galaxies are there in the country? How often do they have accidents? Who's the person I'm selling insurance to? How often have they had accidents? And you put all those into a big equation and say, okay, if you want to insure this car, it will cost you £500 a year, or whatever the number is. And there are so many people with Ford Galaxies insuring their cars that it all goes into a big pot. And if you've got your sums right, you can pay out for the small number of Ford Galaxies that have an accident and still have some money left over. That's how insurance companies make their money. They know exactly how many people have accidents. They know exactly how often they happen. They know that 17-year-olds have accidents more often than 47-year-olds, and they adjust their premiums accordingly. In other words, we can identify what the problem is, and we can quantify how much it would cost to put right. That's not always the case. So it's very easy for a car. It's easy, but not as easy for a house. How much would it cost to replace the house? How much would it cost to replace all the contents in it? And it's almost impossible in terms of something like a new project. How do you insure against a new project not going in on time? Even if you can you insure against the fallout from the problems that it might cause? If you say that you're going to open a new dentist surgery, and that dentist surgery isn't built in time, you can insure against that, but what's the fallout? There might be fallout that people don't get their teeth done. Well, how do you quantify how much that costs? How do you quantify somebody having to wait another couple of months to get a tooth out? So some things that are easy to quantify, we can transfer the risk. Others, not so much. Feel free to jump in at any point here. If you have questions, don't let me just ramble on. If you have questions, feel free. I'm keeping an eye out for hands and questions in the chat. Our next approach is to mitigate. If we say that we might have a problem, how do we mitigate when that, how do we mitigate the fallout when that problem happens? And I'll come back to my example about computers. You can mitigate the effect of not having a computer in your office by having a second one ready to go. Well, that's quite expensive. You're going to have another computer sitting there most of the time doing nothing. So you could have another company who say, all right, well, if your computer comes down, I'll come and fix it. How soon do you want me to be there? And not surprisingly, if you can wait longer, you can wait a day or a week, they'll charge you a lot less than if you want them to be there in 4 hours or 1 hour. And that's where this balance comes in again. Do you want it fast, which will be really expensive? Or are you willing to wait, in which case it gets cheaper? In the end, it's up to you, and it's up to your organization which approach you take. And that's why you have to understand your risks and decide what the consequences are. And you might take different approaches depending on where you're looking. So I've just been talking about a generic computer. You might take a different approach to somebody's workstation. A £200 computer that you could probably walk into Comet, when Comet doesn't exist anymore, you could probably walk into Curry's and buy. And the worst that will happen is somebody's waiting about for half a day while you replace it. That's very different to a server that everybody in the company uses and is essential to the continuance of your work. So you have to understand different approaches at different places for different reasons, leading to different outcomes, which require different approaches. There is no one size fits all for these things. In other words, you have to start calculating what the fallout will be, because you can stop all risks if you, or almost all risks, if you spend enough. But of course, that's not practical for most organizations. So you have to balance what you're going to do against the outcome. Sometimes that doesn't always work. There used to be a computer company called Tandem. And probably when I said tandem, the first thing that came to your mind was a bike with two people on it. Well, a tandem computer was one box, in essence, with two computers in it. So if you were something like a bank, where if your computer went down, it cost you a fortune, you would buy a tandem computer. And if one of the computers in that box failed, it would automatically and almost immediately switch to the second computer. As I say, incredibly expensive because in effect you're buying two computers at once. Many, many years ago, an organization bought one of those computers, had it installed, and everything worked fine for about 3.5 years. And then the computer failed. And the computer failed, and the second one didn't take over. So not surprisingly, there was a big inquest into why not. They specifically bought this machine to come in, to take over, at great expense in case anything went wrong. So they went through the logs to find out what had gone wrong. And what they found was they had installed this machine and actually it had failed within the first couple of minutes. The first machine had died, it had a manufacturing fault and it had died almost immediately. And the system had worked perfectly. The first computer died and it switched to the second computer. But in the realm of startup messages, the message that said, the computer has died, you might want to get it fixed, had been lost. Nobody had noticed it. So that thing had been sitting there for 3.5 years. So it's not always just about putting in the mitigation, it's about ensuring that you understand it properly. If that computer had had a big red light at the top saying not working, not working, not working, that would never have happened. But because the reporting was, here's a line on a screen that says the machine stopped working, nobody noticed. Which tells us a lot about how we should approach risk. It's not just a one-off thing. It's a continuous thing. We need to look at our risks and we need to understand them all the time. We need to revisit them and understand whether they've changed and whether they've gone up or down. And you'll see that in some of the examples I'll show you later. The final one I want to talk about is exploitation, which sounds odd when we're talking about risk, but it isn't really, because we take risks all the time. Oh, I'm going to move to a new house. It's going to cost me more than my mortgage, but I'll have a garden. Well, that's great, but it's a risk. If it's going to cost you more, then you have to be able to service that mortgage, which means that you might have to keep your job, which means that you might stay somewhere you don't like longer than you wanted. There's a risk involved. Organisations do the same thing. They might decide to open a second shop. You have a wee newsagent that's doing really well, you might decide to open a second one. Of course, there's a risk involved. There's a risk in buying the new premises, fitting them out, hiring new staff. The risk that it won't be as successful as your first one. But we take that risk in order to get the reward. Chemical and pharmaceutical companies do the same thing. You can't create a new drug without taking a risk because you don't actually know what's going to happen. Yes, you can do lots of research. Yes, you can go through lots of comprehensive tests, either with other chemicals or with other animals. But in the end, you're going to have to sit somebody down and give them a drug. If you've done all your tests right and got lucky, then the drug will work well. Or at the very least, it won't hurt somebody. But sometimes it does. Sometimes you give someone a drug and it hurts them. So why do they do it? They do it because we want more and better drugs that do better things and address more illnesses. So we could say, no, let's not have any more drugs ever, but people will die. So we balance that risk. The risk that the drug that we create causes harm against the risk that if we don't do it, lots of people will get ill and possibly die. So we understand that there's a risk. We take the risk because we've decided that on balance, it's worth doing. So those are the 5 ways of approaching risk. And as I say, they're a reasonable cross section. Does anybody get any questions on that before I move on to our next part? Okay. So the next thing that we need is a plan. So I've said that we need to identify these risks. We need to manage these risks. So hopefully somewhere, someone has written down what they are and what we're going to do about them. Now, just like with the approaches to risk, there's lots of different ways that we can write these down and quantify them. And I'll show you some of them afterwards. But in essence, it consists of a table that says what the risk is, the kind of category it might be under. Is it about staff? Is it about equipment? Is it about whatever? A guess, because there's no better word for it, because we don't know. But your best guess, using your experience, about how likely this risk is to come true. Your guess as to the impact it will have, either financially or in other terms, like how much longer it will take. Some sort of note as to how you're going to approach it, the plan that you have as to how you're going to approach that risk and what you're going to do about it, and who's responsible. In other words, whose job is it to look after this risk, and whose job is it if this happens? Not as a, oh, it's Fred's fault, but as a, oops, this thing that we thought might happen has happened. Can you call Fred because he knows what to do? So in other words, we have to create a risk register where all our risks are identified, analysed. We figure out what we're going to do if this risk comes true. And as I said, this isn't a one-off event. Our risks should be continually monitored and continually controlled. In other words, we should go back to that risk register on a regular basis to see whether the risks are still extant, whether they have become more acute, or any other aspect of them that we think is appropriate. Risk management isn't a big bang, one-off event. It's a continuous organizational responsibility. Any questions?
Hi, Tony.
Hi.
Can I ask a question about transfer risk and mitigate risk?
Sorry, could you say that again? I struggle to hear. Ask about which risks?
Can I ask a question about transfer risk and mitigate risk? For example, there is an online game company. They have financial difficulties and they have to reduce the configuration of the server. so they can save a lot of money, but the gamer's game experience has declined. So this company's practice is to transfer risk to users or to mitigate risk.
Okay. I've said when we've been talking about this that organizations have to decide for themselves which risks are more important and what's going to happen as a consequence of the risks. And you've just identified one there where the costs of providing the service are too high, but the cost of reducing the service provision is that the users will be upset. If I followed that correctly, yeah?
Yes,
there is
yes.
There is no, here's what you do about it. This is where the organization has to understand its business and has to decide what's best for that business. Because you're quite right, you're stuck between two incredibly difficult choices. Continue with the level of service as is, but the chances are the company will go bust because it can't afford them. Or reduce the level of service with the chance that your users will go somewhere else to get the service that they need. And that's a really, really difficult choice to make. But it's one that happens in commerce all the time. There are huge numbers of examples where it may be that a business chooses to lose money in the hopes of a long-term payoff because they become the preeminent organization. So, for example, there is Uber and there is Lyft. Now, for a long time, every single journey taken organized by one of those organizations lost money. That was paid for by the people who set up the company and bought shares in it. But of course, that's clearly not a long-term option. Why do it? They did it to try and become the company. So in the same way as if you want to search for something on the internet, you say you're going to Google it. You don't say, oh, I'm going to Bing it, despite Microsoft's best efforts. They want to say, oh, I need a taxi, call an Uber. And the other company said, oh, I need a taxi, call a Lyft. Either way, it can't continue. Either way, they're going to have to start raising the prices, and they have done already. And that has caused problems because the kind of people who took these journeys are seeing their costs go up, and they're taking fewer journeys, which of course impacts on the bottom line. So there is no answer. There is no, this is what you should do in this circumstance. Because if there were, I wouldn't be sitting here, I would be head of a multi-billion-dollar company taking all your money instead. Sometimes it's about good management. Sometimes, to be honest, it's about good luck. But these are the issues that have to be managed when you're in that position. And sadly, there's no magic bullet. Is that okay?
Okay. Thank you, Tony.
Any other questions just now? Okay. I do want to show you an example of some risk registers and how they might be shown, but I think before we do that, we should definitely take a break, don't you? So, Margaret's desperate for the next cup of tea. Okay, let's take 10 minutes and I'll see you back here in 10. Okay, so we are back. Hope you got your tea, whatever you fancied. Now, yes, Margaret's got her tea, excellent. Now, I just wanted to remind you, before I go and show you some of these things, that we do our lectures here, but there's more information in the module materials. It's really important that you go through all of this stuff, and I've put it up there for a reason. So it's important that you read through it and understand the stuff that's in here, even if we haven't covered it in an assessment, in a meeting, in a lecture, sorry. So for example, for governance, we talked slightly about OCEG, but we didn't look at the Red Book, which is the kind of baseline for governance, risk and compliance. We talked about the fact that there are frameworks, but we didn't really look at the frameworks in detail, and so on and so on. And it's the same for risk. So we'll talk about some of the things, but not all of them. So please make sure you look at all of the pages that are in these module materials. So what I want to look at just now is some examples of risk registers. So we said before the break that it was important that organizations have risk registers and that those are continually reviewed, and we continue to make sure that they are appropriate for our organization, for the risks that we have, for our people, and for whatever other criteria you wish to use. So, as I've been doing it for a few weeks, I'll continue on with a local authority example. Again, because local authorities have a statutory. Come on, computer. Local authorities have to give this information. And it's included in their terms of reference. There we go. Okay, so here we're looking at Treasury management and investment money, in other words. And what I want to do is look at a particular part of this. So up here, up here on page 24, we have the Treasury Risk Register. In other words, the risk register, but specifically for the financial health of the organization. And before we took our break, we said, okay, a risk register is going to identify the risk, it's going to identify what might happen, and it's going to identify what we're doing about it. So here we've got that example. We've got the first one, credit and counterparty risk. Not a great start, is it? Honestly, hands up, how many of you have come across the term counterparty before? Yeah, me neither. So this can be quite a specialised thing, which is why GRC specialists are paid so much. So a counterparty just means another organisation with which you're dealing. And what if they don't meet their contractual obligations. Now remember, this is a local authority risk register, and some of you may remember that 14 years ago, the financial crash, some banks went out of business. And if you had your money in that bank, you lost your money. And that's the consequence that's shown. Funds won't be returned in full. What you do to mitigate it? Well, you set a minimum credit criteria. In other words, you choose which organisations you put your money in. Of course, it doesn't always work. Nobody deliberately puts their money where they think they're going to lose it. Nobody thought the Icelandic banks were going to fail, but they did anyway. And the final part here is something called a RAG status. And again, if we look at our module materials, there's an explanation on the RAG system. RAG is really simple. Is it red, amber, or green? Do you have a problem? Is there a concern, or are you healthy? So it's a very broad brush approach to risk. So this one says, we have a concern, but it's not a high concern. Next one's liquidity. Do we have enough money? Consequence, we don't have the cash and we can't do anything. Which is a fairly stark consequence of not having enough money to hand. What do you do about it? You understand your organisation. When does money go out? What are the key choke points? When do I need to have money in the bank? When I'm just about to pay the staff, as an example. But understanding long-term projects might be one as well. There might be mortgages need paid, or rent that needs paid, or leasing that needs paid, or new capital projects that are being invested in might need paid. So you have a cash flow forecasting model to ensure that you have the cash in hand to pay all these things. This organisation has that in hand and says, yeah, I'm happy with it. This is green. We don't think this is a problem at all. We've done what we needed to do and we're happy about it. And you can go through the risk register following those kinds of things. Market risk, interest rate risk. And you can tell that this is from 3 years ago because the interest rate risk here is green because we were in a period of stability in terms of interest. Now we are in a period of high instability. That interest rate risk, I suggest, on an updated version, wouldn't be green, it wouldn't even be amber, it would be red. Okay, so we have a modest risk register. Everyone happy with that before we look at our next document? Any questions? Margaret?
Thank you, Tony. I'm just thinking if something was red, I'm sort of trying to work it out in my head, but I'm thinking about the current controls. But if something was red, would there be an effort to put in additional controls so that that wouldn't stay red? I.e. that that the residual risk would be less than, because you'd have to do more than leave it at red, wouldn't you? Or would you?
Well, as with most of these things, the answer is yes and no. Because it depends what the risk is. And it goes back to what I was saying earlier about risks that you can't do anything about. So that particular one for interest rates, what do you do to make the interest rate issue go away? You don't. Well, other than voting for a different government, I suppose. But the interest rate instability, you have very little control over. So it becomes and stays a red issue. What you do is you work through it in other areas of the organization. So the controls aren't so much for the interest rate risk, but in ensuring that other areas of the organization are strong enough to ensure that bills can be paid even if interest rates go up. And that might involve addressing other areas of the organization, reducing expenditure there, or whatever it happens to be. But that's part of the reason for having this risk register. And you see that as an example there. Seeks to minimize expenditure on interest cost on borrowing. In other words, the only thing you can do is not spend so much. And if you've already committed to the spending, make sure that there's money elsewhere in the organisation to have that. And I can assure you that there will be organisations up and down this country right now that are revisiting this because they've borrowed when interest rates were historically low. And they're now creeping up and creeping up. So, for example, if you are at Westminster, and I keep seeing this figure that they keep saying that they're going to build 40 hospitals. So when you build a hospital, you don't just get money out your back pocket, you take out a loan. For a government, that loan is backed by gilts. So in essence, companies buy the loan from the government pays them interest every year, and then eventually pays back the gilt, pays back the loan. For the last 20 years or so, those gilts have paid a low but steady 1.7% or so. In the last 2 weeks, that's gone up to 4.2%. In fact, I saw a figure that it was at 4.5%. So all of a sudden, the money that you were paying back to build that hospital has doubled, going towards tripled. There's very little you can do about it because you're at the mercy of the macroeconomic status. So there's a couple of things you can do. You can say, no, I'm not building this hospital anymore if you haven't started. Or if you have started, you say, okay, well, I need to cut my expenditure elsewhere and we need to not spend money on doctors or nurses because we need to pay for this loan that we've committed to. So it will depend on the item. If the item was on, I don't know, if the item was on this, if it was liquidity risk, was it red? Well, that's saying, okay, we have a problem in how we sort our finances and somebody needs to sort that. Barney needs to get in there and have a better forecasting model sorted out so that we don't get to the point where we can't pay the bills anymore. So it really does depend on the risk, and it depends how much influence you have in being able to affect that risk. Does that make sense?
Yes, very much so. Thank you.
Okay, so that's a financial one. Let's move on to this one. So this is same organization. This one they call a strategic risk report. And the first thing you'll see is it's more complicated. So there's our first page. And there's only one item on it. Having said that, the things on it are things that we've identified before. What is the risk? What is the consequence? What are we doing to make sure it doesn't happen? However, what we've done is we have also moved ahead in how we categorize it. So instead of just having a very simple red, amber, green, we have actually thought a wee bit more about the risk. And we have used a risk matrix. So we have a two-dimensional system. One side of it says, how likely is it to happen? And remember, this is our best guess because nobody knows. If you knew something was going to happen, you could do something about it beforehand. But this is our best guess. So you have likelihood one way and impact the other. How much will it impact us? What are the consequences if this actually happens? So for our strategic risk, the risk is about austerity. In other words, the organisation won't have enough money. So it starts talking about challenging decisions. Almost always that means cutting services or cutting staff. And it tries to figure out how much of a risk this is. And they're saying likelihood, top of the range, it's going to happen. We know it's happening. It's been happening since 2010, since public budgets were cut. So it's going to keep happening, and there's no prospect of that changing right at the moment. What's the impact? Well, almost as bad as it can be. It's going to affect every part of the organisation, but we'll probably keep going. Because if you're getting to this top right one, then that's extinction level. So it's a 20. It's certain to happen, and it's going to have a huge, huge impact. As I said, this is a strategic risk report, and you'll see it's getting a wee bit more complicated because it's starting to talk about which types of risk. So this is still a financial one, clearly. But we're starting to give codes. Strategic Risk Register 01. Strategic Risk Register 2, inequalities. So we're not just saying what the specific instance is, we're saying what we're talking about. The first one is about finance, this one is about inequality. If we have less money, what will happen? Well, clearly people will be poorer. And that will fall, that burden will fall most heavily on those least able to do anything about it, children. What you're going to do about it? Try and get growth. Try and get more people employed, because if you get more people employed, you get more money, so they're not in poverty. For those who can't do that, you have a priority about how you're going to help those people. And there's actually, if you look at this, a whole other page about things that they're going to do. So one page about the risk and the consequences, and a page and a bit about what's happening about it. All from different strategic areas of the organisation, because it's clearly so central to what they do. Financial sustainability of health and social care partnership, another 20, but in a different way. So the impact is as high as it can be, but we think it might not happen, but only just. The chances are it almost certainly will, and it will have a huge impact. Growing demand, decreasing resources. Now remember, this is 2018, 2019. And this is about health. And I suspect I don't need to tell any of you what happened with hospitals during 19, 20 and 21, particularly when there's an increasing need for their services. Julian?
Yes, thank you. Does our report need to look like that or something close to that?
So I'm going to have a presentation on this. So what I'll say just now is you will need to have a risk register in your report, but it's going to be up to you how you do it, because one of the things, and part of the reason I'm showing you this, is to show you that even within the same organization, risk registers can be shown in different ways, depending on what it's there for and what you're going to do with it. So it's going to be up to you to decide what's the right way for your organization to present this information. So I'm giving you some examples. You can find plenty more, and I'm going to leave it up to you to decide. And it goes back to what I said right at the start. I want you to use your professional judgment to think, no, I think this is the best way to show this information. Because if I said, I want you to use system X, everybody in this meeting would use system X. So I'll leave it up to you if that's okay.
Okay, thank you. So we can just be inspired by those examples.
Yep, you certainly can. So we're going through, and I'll spend less time on them now because you can go and read these yourself. Again, with different types of risk. Here it's about people. Do we have gaps in the workforce? Can we recruit new people? Clearly, if we have gaps in the workforce, that's quite a big issue. But we think we can manage it. It's only in the middle of the likelihood. So we think we're still okay. Community capacity building, same kind of idea. If we can't do that, if we can't get people to be more resilient, and how prophetic is that, that you want local people to be more resilient in case of any problems? It will have a big impact if we can't do that. Climate change. This, remember, is a local government organisation, but they're using climate change as a risk. So this goes back to the point Margaret was making. It's on the risk register. How much can you do about climate change? You can certainly address your own organisation's approach, but there's so much extra out there, it becomes very difficult. This organisation may say, okay, well, I'm going to stop using carbon. We're going to move from diesel trucks to electric trucks. Well, that's really good, really commendable. But if everybody else doesn't do it, it's not really going to help that much. Which isn't a reason for not doing it. It's simply pointing out that everyone has to do this to have an impact. What sort of impact? Floods. Paths will go away. We can't get access to the outdoors. We'll have more weather issues. And you saw that in Florida 2 weeks ago. You know, the governor in Florida in America spends his time telling us that climate change is a myth, and the other half of his time coming out telling his residents how to hide from the next hurricane. It's not sustainable. A risk on information and cybersecurity. Clearly a big issue for any organisation that makes any sort of use of computers. And again, I know this is sprung from my IT course, and I know there's people on here not doing IT, but that doesn't matter because all organisations are reliant on IT now. So of course it's a risk. The Scottish Environmental Protection Agency, you don't think of them as being an IT company. But not long ago, SEPA had a cyber attack. It took down all of their systems. SEPA could do very little for a very long time, and in fact, it's still happening. So the original one, says the recovery could take years. They're building a new IT system from scratch. And while they're doing that, they came back again and had a go at their new one. So SEPA, clearly not an IT company, but very much reliant on IT, as most of us are now. So this organization has said, yeah, it is an issue. Mid-likelihood, but high impact. Now, I have some more examples, but I'm not going to give them today. I'll leave that pleasure. Okay, Google, stop. I'll leave that pleasure for next week because I'm acutely aware that I tend to go over time, and I know that plenty of people have other meetings that they have to go to. So I won't do any more of those, but I will show you another couple next week when we're doing the second part of risk. So does anyone have any questions about that just now? Okay, in that case, let me stop the recording.